Hey folks, welcome to today's Decided Share YouTube Live. It is Monday. It is a new 5-session set ahead of us, and most importantly, I should say, it's another wonderful opportunity to learn from the markets. Now, what I want to go through today is using one of my favorite moving averages for perspective. We get a lot of questions, rightfully so, and they're all good questions on moving averages. Which ones do you use, exponential versus simple, all that kind of stuff. So I thought I would show you one of my absolute favorite moving averages today, and it's my primary purpose for it is to use perspective. What I found over time is that most retail investors and traders, and quite frankly, even a lot of institutional folks, don't use enough perspective and long enough charts or long enough time spans to kind of gain perspective where we are. The moving average I'm about to show you, the primary purpose for me is to give me that perspective. Now, what the moving averages is, let me turn this thing around. It's a very simple 50-week simple moving average. And you can see it right here. It's this yellow line on your screen. The actual ticker here is the Russell 2000 IWM ETF. You can see that right up here. Now, the details here aren't all that important. What's more important is why would we use the 50-week moving average? And just so you know, the 50-week moving average comes out to about a 200. The 200-day moving average, I'm trying to say, is not that far off from the 50-week moving average. The 200 days is about 40 or so trading sessions. So why would you use the 50-week moving average as opposed to the 200-day? There's nothing wrong with 200-day for perspective, but the reason I like the 50-week moving average is because it forced me to look on a weekly closing basis, right? So let's have a look at this. So if you were to pull up a chart of the 200-day of the S&P, the Russell 2000 IWM ETF, and you were to overlay it on the daily chart with a 200-day moving average, you would see that it doesn't look all that much different from the 50-week. But the difference is that the 50-week, A, actually tends to work a little bit better on most charts, okay? And B, much more importantly, again, forces us to look on the weekly closing basis. So like, for example, if you were to look at just, for example, like the last 2 or 3 times when the Russell 2000 bounced off the 50-week moving average. Let me just zoom in a little bit closer so you guys can see this, okay? What you want to see is a successful retest of a moving average like that on a weekly closing basis. So like, for example, here you can see that we came into the 50-week. It wasn't a 200 days, so this wasn't just one day. This index here held on a weekly closing basis here, and then the next week, which is this green one here, we bounced off of it. Then we had true follow-through buying for an entire. So this formation here of these 4 weeks or so was very important in order to get long the Russell again. Same thing here. There would have been plenty of reasons to freak out when the Russell 2000 pierced below its 50-week moving average in February of 2018, which is this year. But you can see we ended up holding that moving average on a weekly closing basis. And the very next week, the green candle here was a confirmation buying week, and then did it again just a number of weeks later. So, and now of course we're breaking out, and we talked about that last week as a trade. So that's one of the key things I wanted to kind of just go through today. And we always talk about building perspective, but I think it's unbelievably important to, if you're going to use a moving average, make sure you use it in the right time frame, right? So if you're going to use an intraday moving average, whatever that is, 8 day, 8 minute, 10 minute, whatever it is, you know, you got to make sure that's within intraday, right? But if you use a daily chart, then of course you have to focus on daily charts. And if you can use a weekly moving average, which I think for perspective works wonderfully well, make sure you understand that we're building perspective. So these swing trades here that we have built on this 50-week moving average holding, these are not going to be trades that necessarily have to work out the very next day. You have to look at these trades through a multi-week lens. So really, ultimately, the latest rally we've seen in the Russell 2000, which is this one here, right, was really predicated by the Russell 2000 successfully retesting that 200-week moving average here in early April, and then with follow-through buying in the second week of April, right? And that's ultimately what gave rise to this move. So when you saw this happening, it wasn't something you needed to take advantage of the next 5 minutes or the next 2 days, but for the next few weeks. So anyway, folks, I hope this makes sense. Have a wonderful week. One last thing, actually, this is really important. I'm holding a very special webinar this Wednesday about how when I lost $300,000 trading, how that really changed the way that I look at the market, and I'll show you guys some really juicy nuggets I learned from that and how it literally turned away around my trading for the better once and for all, I hope. And make sure to join us for that if you can. It's on Wednesday, May 23rd at 7 p.m. Eastern, so that's 7 p.m. New York time or 4 p.m. Pacific time. If you want to join us for that, let us know. There's a link down below or in the email if you received this by email. Have a wonderful, wonderful week, and I'll talk to you guys tomorrow.